Today is Monday, June 9th, and before we talk about the stock market today, we're going to talk a little bit about this one big beautiful bill, because I'm going to argue that instead of that, we need to have a one big beautiful battle axe to take to the federal budget. But let me help you understand what I'm talking about. I discussed this in my upcoming book, Evidence-Based Investing, that the reality is that if we have a national financial crisis, that crisis is going to become your crisis too. So let me show you what I mean. On the screen right now, we have the federal debt as a percentage of GDP. And what I want you to see is that currently our national debt is 121% of our GDP. And before going any further, let me make sure you understand that all my comments today are bipartisan comments. And what I'm trying to get across is that the longer it takes us as a nation to stand up and fix some of the problems, the worse the solutions are going to look. Now, if you do your history, you study the national history, you'll see that our nation has a history of creating debt in a time of crisis. I would argue that's good debt. Maybe we can talk about that sometime. But then we tend to pay that debt down. But we've stopped doing that, and it's just compounding. And so eventually you have to start saying no, and you have to start cutting. Otherwise, we're going to get buried by our debt. Right now, we are already spending more on interest payments on our national debt than we are on our defense spending. That is not a good sign. If we were attacked, we are buried under our own debt payments. That's not a good sign. And again, this problem goes back decades. On the screen right now, we've got deficits or surplus. So if we're above the black line, that's a surplus. This right here is the end of the dot-com crisis when we actually had a surplus. But if you go back and you look, our deficits have been growing since the 70s. So again, I'm not making any comments about the current administration. I'm making comments about all of the administrations since at least the 70s. This problem has gotten way out of hand. Sadly, in our world, there are too many economists who have a D or an R behind their name. So one of the things that's important to me when I'm following an economist is I want to make sure that I'm listening to people who are calling balls and strikes evenly. Regardless of who's at the plate, I want to see that balls and strikes are called the same. Brian Westbury from First Trust, I would argue, is one of those economists. And he recently tweeted this out. In other words, the One Big Beautiful Bill Act does nothing to return the United States to a level of spending where it would even be possible to balance the budget. This is a book that I'm reading currently, Modern Portfolio Management by Todd Petzel. It is massive. It's taken me a long time to get through it, but it's a very well-researched book, and I'd like to share with you one of the things that he says about sovereign debt. Sovereign debt is usually considered the best possible debt. Matter of fact, if you take a finance class, you'll learn that many people consider U.S. Treasury bonds as the risk-free asset. Why? Because the U.S. government has never defaulted on their debts, and because the United States government, like any government, they have the ability to raise taxes so that they can service the debt. But take a look at his conclusion. A spotless sovereign credit history is the exception rather than the norm. I'm going to show you a page from my upcoming book, Evidence-Based Investing. In writing my upcoming book, I found some research by the Bank of England, and they pointed out that 151 nations since 1960 have actually defaulted on their debt. So this is not abnormal. It is actually, I would argue, a little egotistical of us to consider the fact that the United States government would never default on their debts, because there's so many nations across history that have already done so. Another book that I'm reading right now is Ray Dalio's recent edition, How Countries Go Broke. Here's a hint. It's too much debt. Take a look at his conclusion. Debt crises are inevitable. So this debt crisis, I would argue, is upon us. And in particular, this chart here is why we need to lean on our elected officials to address the federal debt. because we are no longer in a declining interest rate environment. Back in 2022, we had a secular trend change. Since the 1980s, we've been in a declining interest rate environment. That is no longer true. And if we zero in on the right-hand side of the chart, I see a rising channel, which suggests interest rates will tend to move higher. That's going to make paying down our national debt even harder. It's going to put the strain on our federal budget even harder. Now, there is some good news. According to Ray Dalio, he does say that most debt crises, even big ones, can be managed well if economic policymakers spread out their negative impacts. So I'm curious to know what you think. Leave me some comments in the comment section below. What do you think? Do you think the federal government needs to start cutting their spending? And if so, what do you think that they should cut? Now, recently I was reading an article and it mentioned NPR and public broadcasting stations, or PBS. And I thought, well, yeah, that makes sense. I mean, 50, 60 years ago, I could argue that maybe it made sense for the federal government to fund these two broadcast channels, but does that still make sense? Shouldn't they be able to sustain themselves on advertising revenue in today's world? I don't know. I'm curious to know what you think. And if you're not connected with me on LinkedIn, I post a lot more stuff on LinkedIn on a regular basis. Happy to have you engaged with us there. As far as the stock market is concerned, one point we'll make and we'll wrap up. This is FANGS, FNGS. It's an ETF. It's got 10 stocks in it, all technology related. Last week, it made an all-time high. But here's a concern that we have. Now in the top pane, I've got the NASDAQ. And while it has had a very significant rally off of that April 7th low, what I want to highlight is right there. Only 33% of the NASDAQ stocks are above their 200-day moving average. So we're not necessarily out of the woods. It's looking a lot better, and we're starting to see some opportunities, but don't just go dumping all of your money in the markets. Be wise, manage your risk. If you have any questions, let me know.